Yesterday, Goldman Sachs announced its 2025 class of managing directors. 638 vice presidents claimed one of the most coveted roles in banking. But one of the bank's top VPs didn't stick around to find out if he made it. Wajih Ahmed, one of the bank's most prodigious young traders, has left Goldman Sachs for hedge fund Balyasny at the age of 29. Other young star traders have left banking for the buy side. Some have thrived, some haven't. Find out why on the Coffee Run. Ahmed joined Goldman full-time as an 18-year-old math prodigy, at which time he already had a master's degree in finance and economics from the London School of Economics. At 24, he became one of the bank's youngest ever vice presidents. Ahmed was already famous within the bank as an intern. He made headlines for completing a project in 2 hours that was supposed to take 2 weeks. Goldman tends to have the policy of, if you're good enough, you're old enough, and has promoted people to MD in their 20s multiple times before. At the age of 29 now, Ahmed may have grown impatient, and when a fund like Balyasny comes knocking, it's a knock you tend to answer. Balyasny is the hedge fund of Dmitry Balyasny, a former door-to-door salesman who made his name at another hedge fund, Schonfeld. It employs more than 2,000 people and pays its trading staff pretty well. In its London subsidiary, for example, it paid £1.5 million on average to 161 employees in 2024. Balyasny is supposedly a very nice hedge fund to work for, at least according to Balyasny himself. He told Institutional Investor that the fund focuses more on solving people issues than it does on solving market issues. Balyasny suggested that people are willing to come to his hedge fund at lower pay than they might receive at hedge funds elsewhere because of his approach to people. The fact that £1.5 million per head is supposedly the low-paying option on the buy side may illustrate why Goldman was always going to struggle to keep Ahmed. What would have happened, though, if Ahmed had stayed in banking? Perhaps he would have had a similar trajectory to Kunal Shah. Shah was another young star trader, making MD at the age of 27. At 31, he was promoted once again to partner, an even more lucrative rung up the ladder, where $950,000 salaries appear to be the norm. Today, Shah is the co-CEO of Goldman Sachs International, the bank's London subsidiary. Other people wait until they make MD, then leave for the buy side anyway. Dan Avery made Goldman MD at 28 years old, then 5 years later moved to hedge fund Millennium. He's also currently working at Balyasny though, building out a Delta One team in London. Sam Barbarian was promoted the same year as Avery at age 29. He first left for another bank, Citi, before becoming Citadel Securities head of credit trading. Leaving for a hedge fund doesn't always work out well, however. Just this week, we reported on Maxwell Lee, a systematic commodities trader who made MD at Bank of America aged 27. At BOFA, he reportedly made $120 million in a 3-year period before leaving for relatively new hedge fund Jane Global. He lasted just 10 months at the firm, which has posted modest returns of roughly 2.5% this year. It's not clear why he left, but other commodities traders have been seen leaving the firm less than a year after they joined. Moving to a hedge fund is risky because they're generally much more ruthless in a drawdown, i.e. when you're losing money. Some funds have strict risk systems in place where, when your drawdowns are too severe, you're pressured into selling off your positions, even if there's a good chance of their prices rebounding. At some funds, like Millennium, if you make a loss in 1 year, you'll have to make back that loss in additional profits the subsequent year before your profit counts towards your bonus. Portfolio managers stuck in this situation are referred to as zombies. Balyasny isn't thought to take this approach. Some other major hedge funds like Citadel aren't thought to either. Brent Donnelly, a former trader in banking that left for a hedge fund, told us back in 2022 that, of 10 other bankers he knew that left for hedge funds, 3 went back to banking and only 4 are actually doing well over on the buy side. If you're a star trader at your bank considering moving over, think carefully. That wasn't the only big story in finance this week. As we mentioned earlier, Goldman Sachs announced its new managing director class. 638 vice presidents and executive directors have ascended into immortality. The bank promotes MDs every 2 years, alternating yearly with its even more exclusive partner promotions. This year's MD class was larger than 2023's, but just shy of 2021's record intake of 643 MDs. More than 70% of MDs were in revenue-generating roles, suggesting the bank has high hopes for deal-making, sales and trading next year. It already predicted this year that 2026 will be a record year for mergers and acquisitions. Who were some of the lucky VPs to make the cut? Soraya Shenaf, a Paris-based FX salesperson, was promoted. So was Joachim Toberson, working on FX and rates coverage in Stockholm. Outside of the front office, new MDs include multiple women working in risk and compliance. New York-based Anita Breslica, head of investment risk for asset management, made MD. Dallas-based Christine Banks was also made MD while serving as the bank's head of fraud. The bank has faced some criticism for the lack of women involved in the promotion, however. 27% of new MDs were women, the smallest proportion since CEO David Solomon took the reins in 2018. It's the culmination of a long journey for 31% of its new MDs, who started out as intern and graduate hires. The average newly promoted MD has worked at Goldman Sachs for 12 years. With that journey now, in a sense, over, they may look to follow Ahmed in leaving the bank. A Goldman Sachs MD speaking anonymously previously told us that the true benefits of becoming an MD come after you leave. It gives you a serious level of credibility, and by the time you make MD, you've built out an impressive network to capitalise on that, particularly via the bank's alumni network. There's a phenomenon called the Goldman discount, where people willingly work for lower wages at Goldman Sachs because of that visibility and networking potential. While there's potential to make a lot of money as a partner, it's likely that many of the new MD class already have their eye on the door. Separately, a JP Morgan analyst is taking her bank to court. Sadia Najib, an analyst in London for 3 years at JP Morgan, is suing for £58,000 over pay discrimination, alleging a male colleague was unfairly paid more than her. Najib, working in JP Morgan's private bank, earned £55,000 in her first year. She alleges that a male colleague at the same seniority earned £60,000. In her second year, Najib said that same male colleague was earning £8,000 more in salary than her. Taking a bank to court over an amount that she could easily earn as a bonus had she stayed on her career path is a peculiar move, but it doesn't appear to be about the pay itself. When she brought the pay disparity to her manager's attention, Najib said that she received a rapid succession of negative performance feedback, which she said was an attempt to build a case against her that ultimately succeeded when she was placed on a PIP, a performance improvement plan that is often the precursor to getting laid off. Najib said that she wasn't invited to certain office events and was denied access to training opportunities that male colleague had taken. The suit is seeking compensation based on both the pay disparity and the quote-unquote significant emotional distress Najib said the bank caused her. And New York bankers will be in for an interesting few years now that Zoran Mamdani has successfully been elected mayor of New York. One of the key policies in his platform is a 2% tax on those earning an income above $1 million, but opinion on him in banking seems mixed. Senior bankers, those already earning over $1 million, are supposedly outraged. One ex-bank MD, now at a hedge fund, said that people in financial services are freaking out about Mamdani's appointment, but said that those who didn't foresee it haven't been paying attention. The ex-banker said that staff supporting these banks by cleaning trading floors or stocking the pantries are those that voted for Mamdani. He said the opportunities for social mobility are non-existent in New York today, and that bankers thriving on over $1 million are simply living in a bubble. Interestingly, it seems many junior bankers are also pro-Mamdani. Voting data shows that Mamdani was popular with young people, educated people and renters, all part of the junior banker archetype. He was particularly popular in areas like Bushwick and Park Slope in Brooklyn, which are thought to be full of people making six-figure incomes but living paycheck to paycheck because of skyrocketing living costs. Despite inflation, salaries for New York junior bankers have been flat at roughly $100,000 for the last 3 years. Whether Mamdani can actually deliver on his policies remains to be seen, as he won't assume his elected role until New Year's Day. Politics may soon become quite a touchy subject in Wall Street offices regardless. Thank you for watching The Coffee Run. If you want to receive daily news updates on stories like these, click the link below to subscribe to Morning Coffee, our newsletter that breaks down the biggest stories in banking and financial services from Monday to Friday every week. Next Friday, we'll be back taking a look at one of those stories in more detail and letting you know other important stories you might have missed. If you want to see more of The Coffee Run, like this video and subscribe to the channel.